How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to discuss in full detail the best income annuity and go over the pros and most importantly, the cons when you're trying to figure out which annuity contract might be the best one for your specific situation. And many times individuals fall victim to the traps, the marketing traps I like to call them, or the smoke and mirrors. And what I mean by that is do not get held up. Anytime that you're hearing about these features with these types of products, do not get held up on different things known as premium bonuses. Do not get held up on guaranteed withdrawal benefits. So guaranteed riders, like ones that talk about a 7% guarantee. Ones that will provide you this unbelievable rate of return on an income base as opposed to what your physical money is doing. So with this conversation, I really want to gear it in and say, okay, what is the garbage that you want to try to avoid with the best income annuities? How exactly can you find the good ones out there? And if, let's say, there's 1,000 different options for your particular state, for your particular situation, maybe 990 of them are going to be garbage options. Those 10 that are going to be good options can be very good options, could fit like a perfect puzzle piece for your situation. So if we're looking at those statistics, we're saying, wow, there's a very high chance that if you're going into an annuity contract, it's probably going to be a garbage type annuity. So how exactly can you decipher a good one from a bad one? And then how can you decipher the absolute best one for your particular age, for your particular income goal, and make sure that you don't fall victim to those most common mistakes that allow an insurance company to leverage the client rather than have the client leverage the best contract and leverage the insurance company properly. So that's what we try to do, is educate you guys to say, okay, this is what an income rider means. This is why you might want to place your dollars into a hybrid annuity over an immediate annuity, over a deferred income annuity, and just go over, all the list of pros and cons. The first aspect to understand, whenever you're looking at the income that an annuity contract can provide, you have two main options. You have annuitization versus an income rider. An annuitization is the most basic type of annuity, and every annuity contract actually has this annuitization provision. So whether you're looking at an immediate annuity that says you're going to give a lump sum amount to the insurance company, and the insurance company is going to provide you a guaranteed lifetime income till the day that you pass away, this is going to be out in the form of annuitization. So with these immediate annuity contracts, these were the first ones that come out, and annuity contracts are supposed to be the opposite of life insurance. So with life insurance, an individual is paying a set premium each and every month, each and every year, to an insurance company, and then the insurance company is going to pay out a lump sum to the beneficiaries in a tax-free manner. With an annuity, what they're doing is they're placing a lump sum with an insurance company. The insurance company is going to be paying these monthly premiums, these annual payments, each and every year until the day that that person passes away. So it's really in that reverse order. If you kind of think of it, this protects you, an annuity protects you from living too long. Life insurance protects you from dying too soon, or at least protects your family if the breadwinner dies too soon. So when these first sort of annuity contracts came out, all they had was that form of annuitization where they said, okay, if somebody has $100,000 and let's say this individual is age 60 and they place it in with an immediate annuity and this person takes the single life only option, maybe the insurance company is going to provide them $5,000 a year of lifetime income. So this person that's placing their monies with that insurance company says, okay, well, if I live past the age of 80, I'm now receiving $5,000 of income every single year. If I live to 90, let's say this person passes away at age 100, he would have been able to place in 100 grand, receive back $200,000 worth of payments for just really easy math, because this person passed away at age 100. So that break-even point was at age 80, and this is when he starts getting into the insurance company's pockets, is every single year, past that age 80, because $5,000 times 20 years is, equates to that $100,000 amount that was his initial premium. So the problem with this sort of annuitization phase is, what happens if this person triggers income at age 60 and then passed away 5 years later? Well, they would have been paid $5,000 per year for the next 5 years, which is 25 grand. They would have given the insurance company 100 grand, and the insurance company now walks away with $75,000 of pure profit. So insurance companies are able to give this specific contractual guarantee because they leverage something known as the law of large numbers. They say, okay, if this 60-year-old is placing their dollars in there and millions of other 60-year-olds are placing their dollars in there, some individuals are going to pass away before that age 80 mark, and other individuals are going to be living past that age 80, but because statistically individuals are supposed to be passing away at a break point, we could generate a profit in this. So what they're doing is they're leveraging the law of large numbers, and that's how they're able to give you that guarantee. The reason why the person places their dollars with this annuity contract is for that peace of mind that they're always going to be receiving lifetime income. Even if their bucket ran dry at age 80, the insurance company is still giving them that specific $5,000 of income. So a lot of people didn't like that concept, and they said, well, I've accumulated my money. I've accumulated 100 grand in this example my entire life. Why am I going to take that risk if we know that the insurance company is just going to win each and every time? So this is where the income riders came about, and this became out in early 2000s. And first it was variable annuities that had this feature, and then you had these fixed index annuities that came out with it right around 2008, that give it a little bit more juice, a little bit more income juice. And the way that this one works is, let's say if you have and we'll just go off of the more recent income riders, so the hybrid annuities, which are the fixed index annuities with income riders. The way that this works is, let's say the same individual has $100,000 and they want to trigger income immediately. What they're doing is they're not surrendering all their money to the insurance company. They're allowed to still have control of their monies. The insurance company is providing them that $5,000 of guaranteed lifetime income through the form of that income rider. The income rider is going to be, there's going to be a cost for that income rider, something as high as 1.25%, as low as 0.50% per year. So the income rider has to be justified. And what happens is this individual says, okay, I'm age 60. I want to trigger income within the first 30 days. The insurance company is paying him $5,000 a year. And let's say that same scenario where this person passes away after 5 years. Let's say there was no growth on his account value. They passed away after 5 years. For easy math purposes, we'll just say that the insurance company paid out $25,000 and his account value is sitting at $75,000. What happens? Well, in this scenario, we understand that the insurance company is keeping a $75,000 profit, and they were reinvesting that $100,000 on the back end. The individual gets to now have growth within their account. They have that peace of mind that $5,000 is going to be coming to them because they're using that income rider. And if they passed away within that before that break-even point, the $75,000 now goes to the beneficiaries. So they didn't just waste their money. They didn't just say, okay, I accumulated this money, now I surrender it to the insurance company. They're saying, okay, I'm accumulating this money, I'm getting safe, consistent growth in this money, I'm receiving lifetime income from this money, and if, God forbid, if I passed away too soon, my beneficiaries would still receive whatever's remaining. So that's why I like the concept of an income rider a lot better than annuitization. Annuitization, you could set up for a single life income, for joint life income. You could set up for a period certain of years, like say 10 years, that are guaranteed to get paid out. So if the person passes away in year 5, the beneficiaries could receive another 5 years. So there's a whole slew of different things. The concept to be mindful of is insurance companies love individuals to annuitize their monies. Why? Because the insurance company gets to control the monies a lot better. They may get to make a much larger profit than leveraging contracts with income riders. So, let me clear off the screen. If we're looking for that immediate income need, let's say if we had that individual that was age 60, well, yes, they could place their money in an immediate annuity and receive guaranteed lifetime income, but it's tricky with how you're doing it through annuitization, is because the insurance company loves individuals to get set up in immediate annuities because they get to control their profits a lot better. When you're setting it up into the hybrid annuity concept, this is saying that you still have access to your account value, but you're using an income rider that's going to charge a fee. My whole point is that fee is necessary because it gives you that peace of mind that if you passed away too soon, that money's going to get paid over to your beneficiaries. Let's say if you hit that break-even point, like at that age 80, and you keep living and living and living and living and living, and you have no more monies left in your account value, well, the insurance company is still paying you that $5,000 off of the hybrid annuity side. The other concept to be mindful of is when you set up your contracts in annuitization, you lost full control of those monies. So if you're giving $100,000 into an immediate annuity to an insurance company, Well, now you can't reinvest this money. You can't pull this monies out in case of an emergency or in case you want to travel or take a vacation, whatever that is. You are only susceptible to whatever that guarantee is. So if it's $5,000 a year of income, you have to wait until that paycheck comes if you're taking it on an annual basis or you're taking it on a monthly basis, however you're taking that distribution. On the hybrid annuity, your main account value is getting tied to a fixed index annuity, which is like a bucket with a lid over it. It's going to grow when the market goes up, gain 0% when the market goes down. So it gives you that better chance to beat at the pace of inflation rather than say, okay, I'm just going to surrender all my money to the insurance company. Yes, they're going to give me an income stream. This says I'm going to at least have better control on my money and I'm still receiving that guaranteed income stream from the insurance company. So that's my mindset behind it. Understand, insurance companies love the annuitization phase. They're going to tell you 10 million reasons why annuitization is great. I personally think annuitization is horrible for the client. I think it's just better for the insurance company to just leverage the client properly. Once again, we're an independent agency, so we work for the client. We don't work for the companies. We represent a lot of these companies, but we make sure that out of your 1,000+ different options that come back, we're going to give you the top 3 recommendations for your particular situation. So that brings me to my next level, which is the deferred income. This is set up for the individual, and I go over a couple of these concepts off of the YouTube videos. And what I say is, let's say if we have an individual that's age 60 and they're looking to retire at age 65, there's a way on how somebody could leverage a deferred annuity to make sure that's going to correlate exactly to whatever their income goal is. So once again, you have annuitization type deferred annuities, which are known as deferred income annuities or DIAs. And that same sort of concept, you're losing control of your money. The insurance company is therefore going to be able to provide you that lifetime income, but that's all you're receiving is just that income stream. So you're surrendering those monies to therefore, in this example, have a 5-year deferral to therefore receive that, that X amount of thousands of dollars. So like, let's say if this person's age 60, they give $100,000 to an annuity company that's doing annuitization through a deferred income annuity. Maybe instead of that $5,000 of income, this company is going to provide them $10,000 of income starting at age 65. And this is just a hypothetical example. So what this person does is they surrender their full $100,000. Let's say that they're taking in the form of a single life only option, and they passed away at age 63. Well, the insurance company now gets to keep the remaining $100,000. There are some different provisions with the DIA that you could have, like any of the premium that was paid into it, that you could have that paid back, but it's going to dip into what that lifetime income amount is, depending upon which feature that you choose. But ultimately, you're not able to pull from these monies. You surrender those monies to the insurance company, and the insurance company is providing you this guaranteed lifetime income. So you understand this concept, you wait those 5 years, you're receiving $10,000, so you're saying, okay, if I live past that age of 75, that's my break-even point where the insurance company is still paying me $10,000 of lifetime income. So if you live to, let's say, age 95, you made an additional $200,000 of profit because you got into the insurance company's pocket. So I don't want this to look too garbled on the screen, so I just cleared out the screen. Basically, we understand that concept of annuitization. We understand the pros of it is you're going to have that peace of mind that you're going to be receiving that type of pension type income stream. When you're leveraging a hybrid annuity, the one in particular that I'm going to discuss is the FIA, the fixed index annuity with an income rider, and most importantly, how this income rider works. Because if you have 1,200 different options available, and these are all these hybrid annuities with income riders, and I'm telling you, maybe 10 out of these 1,200 are pretty good for your situation. 3 are going to be very good for your situation. How can you decipher a good contract from a bad contract? How could you decipher a good income rider from a bad income rider? The way that this FIA, the fixed index annuity, works is this is going to be your physical money. That's going to grow based upon how a fixed index annuity grows. So it's going to grow when the market goes up based upon the index that you chose, based upon that contract, that company. It's going to grow when the market goes up, gain 0% when the market goes down. That's what's going to be happening with your physical money at each time. If you need to pull those monies out, there's certain provisions that allow you to pull those monies out. You get to have free withdrawals. You get to have, let's say, God forbid, you passed away. Whatever's sitting in your account value would go to your beneficiaries. All those different features. The part of this conversation, though, is the income rider. Because many times individuals hear 7% annuity guarantee, 8% guarantee, 12% premium bonus. All of these different things, withdrawal rate percentages. What does that mean? What exactly are those concepts? How do I know whether a company's telling me they have a 7% guarantee or a company's telling me they have a 5% guarantee? How do I not get tricked into going with the 7% guarantee if the 5% is actually going to provide me more lifetime income? Let me pull up my PowerPoint presentation. Okay, so let's say you saw an advertisement online. You saw it through the television, and you decide to call up that company. And you have company A that's giving you an offer of a 7% roll-up guarantee, and company B that's giving you an offer of a 5% roll-up guarantee. And you have a lot of faith in this agent with company B, you have a lot of faith with this agent in company A, and you're trying to decipher which one is the better contract. Well, on the surface, an individual is going to look at this and they're going to say, oh, well, this is a 7% guarantee. Obviously, this is going to be a better lifetime income. And understand this is what I'm talking about regarding your income rider side, your income base. And I want you to be very mindful that in order to determine what your lifetime income amount is, it's going to be a formula. It's going to be a calculation off of your income base, this number, or this number, multiplied by your withdrawal rate percentage that's set up with that contract. So we understand your physical money, that's gaining when the market goes up, not losing when the market goes down with the FIA contracts. This income rider, depending upon which company is going to have a specific income rider, some call it GMIB, another company could call it a GMWB, you could call it a PIV account, is all these different terms. Break it down to basic terms, income base. What determines our lifetime income? Income base multiplied by withdrawal rate percentage. So we have the individual that's age 60 that says they're either going to put their monies $100,000 with company A or $100,000 with company B. Company A, for easy purposes, says 7% simple interest. Company B says 5% simple interest. This is on our income base. After year 1, person 61, their income base is looking at 107, 62, 63, 64, 65. Age 65, this person wants to trigger lifetime income. So when you're looking at this, you're going to say, okay, well, company A is giving me a 7% guarantee. Company B is giving me a 5% guarantee. Company A's income base at age 65 is $135,000. Company B is $125,000. Of course, I'm not going to be that stupid. I know 135 is higher than 125. I'm going to go with this company. And that's not the way on how to calculate the formula. This is the trick that company A is trying to do when you have company B that's being more honest about it. What I mean by that is, let's say if you're looking to trigger lifetime income, this individual is a male, age 65, placed the dollars in there at age 60, they've received all those guarantees. What's going to determine their lifetime income? The income base multiplied by the withdrawal rate percentage. So let's say if company A has a withdrawal rate percentage of 4% and company B has a withdrawal rate percentage of 5%, which one determines more lifetime income? And when you multiply these, you realize that company A, even though it looked better on the surface, with that 7% guarantee, they only offered $5,400 out of your $100,000 deposit, while company B offered $6,250 out of your same $100,000 deposit. So that's a way on how you get through the smoke and mirrors, to say what the income base is, what the withdrawal rate percentage, what is your actual physical money, what is your guaranteed lifetime income. Because if we were to break this down into a cash flow percentage, you're providing $100,000 to company A, they held onto your money for 5 years and they're providing you a 5.40% cash flow off of your monies. Company B is providing you a 6.250% cash flow off of your monies. So obviously this is going to be much higher. Let's say if we're looking to do a calculation and figure out, let's say if somebody has a need of $30,000 of income that they need by age 65, and you're going with either company A or company B, the whole trick with annuity contracts is I say you want to place the smallest dollars in there and only as much as necessary. If you have a lifetime income need of $30,000, well, you have company A that tells us that $30,000 divided by 0.05400, that's the cash flow, means that company A, you have to put in $555,000 to correlate to that $30,000 income goal. You have company B, we're using $30,000 as the income goal, divided by 0.06250 equals $480,000. So you saved yourself almost 100 grand because you didn't get caught up in the smoke and mirrors effect that company A was trying to show you as opposed to company B. This is why it's more important than ever to understand what you're getting involved with so that you don't realize 3 years later, after you're already subject to surrender charges and subject into these annuity contracts, that now you're saying, oh my gosh, I wish I would have known better before I made my purchase. Please understand that I'm using hypothetical examples. That 5.4% cash flow could be a much higher number with that same example, but I just want to show you the concepts conceptually, what makes more sense. So we want to look at, if you're looking for a lifetime income, first off, why are you looking at lifetime income? Is, some agent just trying to force feed you an annuity, or does it actually correlate to a goal? So like, let's say if somebody's age 60 and they understand that they want to retire at age 65, well, we want to determine how much income they need at age 65. What are their income sources? Are they going to trigger Social Security? Maybe after they do their budgeting analysis at age 65, this person needs $50,000 of income. They're receiving Social Security income at age 65 of $30,000. Maybe they have pension income that's coming to them at age 65 of another $10,000. So therefore 30 plus 10 is $40,000. And now their gap is 10 grand. So that's very simple. What we do is we figure out what this number is. We figure out what they are right now. We figure out what their assets are. Let's say if they have $400,000 in a 401k account, they have $100,000 in a cash account, they have another $300,000 in brokerage accounts. So this person has 700 grand total. Sorry, 800 grand total. It's been a long day. And out of this, we need to suffice that $10,000 income goal. So what you could do is leverage the best annuity, best income annuity, to take care of that to take care of that income goal for further peace of mind. So maybe we're finding what the best 5-year contract is that provides us an 8% cash flow. And when we pull up the calculator, we're saying, okay, the need is $10,000 divided by 0.08%. This requires a deposit of $125,000 out of this person's 800 grand. Why would they place any more dollars into that annuity contract if they don't have to? We're using it specifically for that purpose. So now we're saying, okay, the income sources, we use 125,000 out of that 800,000. So now we have $675,000 left over. Maybe because they have they need to receive $50,000 of income. Well, leg two, we'll make sure that they have emergency funds set aside and completely liquid cash, not tied to the market, not tied to annuity income, completely liquid cash of another $50,000. So we have 125 that's in that annuity contract. Maybe we use the 401k money, so it's an IRA annuity. We have the other $50,000 that could be coming from that same 401k that we'll have it in like an IRA money market account. That's $175,000. So now we're saying this person still has $625,000, and now we could correlate that to their inflationary goal. We could correlate a portion of it to a death benefit goal, to a safe, consistent growth goal. Whatever that case may be, there's so many different ways to skin that cat. Typically, we recommend like a tactical money management or like an annuity laddering strategy on that concept, but you have options. It's not force feeding you down an annuity. An annuity is correct for that situation to make sure that you're receiving those lifetime income amounts, those guaranteed lifetime incomes through the claims paying ability of the insurance company, but do not get caught up in an annuitization type contract. Do not get caught up in an immediate annuity, a deferred income annuity, a DIA. My recommendation is typically which ones are the best 1,200 different options on the hybrid annuity side, and then out of those 1,200, which ones are the top 3? Why are they the best? What are the pros and cons of each? How exactly can you leverage your existing assets to place the smallest amount of dollars that correlate exactly to your income goal? And that's how you're setting up a plan. It's setting up an income annuity strategy or an income strategy or retirement planning strategy rather than a big guess. Because your other aspect that somebody could do is say, oh, I'm just going to take my money, I'm going to throw it in the market, and then I'm just going to slowly pull out monies, each and every year that I need it for retirement. And this is the mistake that individuals make. This is the mistake why a lot of seniors, while you have majority of seniors and retirees, 70 to 90% of seniors are not able to properly retire and they outlive their monies. Is because when you're pulling monies, if you're leaving your dollars in a variable type account, let's say you're tying it to mutual fund related accounts, there's going to be a fee associated with that. Let's say if you're going and you utilize a financial advisor, and that advisor is going to charge you an additional fee. That's a negative associated with your account. That's a negative associated with your account. Let's say if the market goes down and you say, okay, well, I'm going to invest in index type funds and the Vanguard index funds that the market's going to go up, I'm going to have a gain, market goes down, I'm going to have a loss. Well, in 2008, individuals tried doing that and they lost 40, 50, 60% of their portfolios. You have 800 grand. You get hit with a $400,000 loss that year, and you're paying fees, and you're paying an advisor fee, and now you're starting to pull out money for income. That changes your lifestyle. That changes how you can plan out for retirement with confidence. You could have just created that solution by leveraging a very small portion of that 800, make sure that's safe, secure, protected, receiving lifetime income from those annuity contracts, and now you have those rest of those monies that you could leverage as your fund monies. If you want to do those passive strategies, those tactical money management strategies, you have those that flexibility to do so. So it's all about making sure that you're figuring out your number and then scaling backwards and then finding what the best solutions are on an efficient route. And that's setting up a plan, that's setting up a strategy. It's not taking a guess. And that's how people have retirement confidence. It's not that difficult of a concept. Just you have to be willing to do the work. You can't just say, oh, well, it sounds too complicated, so therefore I'm not going to try to bother with my education. It's become educated. And, when you're watching these videos, if you have certain questions, feel free to give our 1-800 number a call. We're available 24 hours a day, 7 days a week, and that's what we're here for. What you can expect is when calling in, you're going to talk to an assistant. You're going to say, hey, listen, I watched a YouTube video or I listened to a radio, advertisement or whatever it was, something found interesting. I want to learn about whether or not there might be a best income annuity for me, or there might be a financial planning strategy for me. And that person is going to correlate you directly to a specialist that could best suit your needs, whatever is in your particular area. We work on a national basis, and we're going to try to figure out where are you right now, how to get from point A to point B, where you want to go. Can you accomplish this goal efficiently by what you're doing, or are there certain gaps in that plan? Are there small gaps where it'll just be a quick fix? You leverage some dollars here, leverage some dollars there, or is it going to be a huge ultimate plan that has to be segmented to make sure that you have that peace of mind in retirement? So that's what we try to do. We're A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. It's because of this methodical process. If you found value in this video, please feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys, for watching, and look forward to speaking with you. Take care.